I think it was a rough quarter for most companies. In the crypto space, we obviously had some big episodic events that happened during the quarter. And so some of those asset prices shrunk, which then impacts things like the assets on platform and other numbers.
The pipelines going west from Russia are the critical link to energy security in Europe. Russia is willing to flex its energy muscles against Europe, and this could be a sign of that.
Due to the macroeconomic uncertainties, as well as due to high levels of inventories that customers have built across various end market segments for us, those inventories are being adjusted down, and that is what is resulting in reduced demand for us.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Inflation fears, stocks and bonds drop before key U.S. CPI data today. Chinese price growth hits a two-year high. The big sell, well, the world's richest man, Elon Musk, offloads nearly $7 billion of Tesla stock in case he's forced to buy Twitter. Plus, collapsing demand. Well, Micron is the latest chip maker, warning that business is rapidly crumbling. Now, first thing is first, so let's check in on the markets, and this is what we're seeing across the board. If we look at some of these European stocks, pretty much unchanged. The focus, of course, firmly on that U.S. CPI data out at 1:30 p.m. UK time. That should give us a good indication on what the Fed does. Certainly, the market pricing in for extra hikes, but then we have worries about energy costs, maybe even going up than we're expecting, and then certain pockets of deflation. I would suggest the 2-10 spread is really the one that we need to watch out for. That two-year Treasury rate actually exceeding the 10-year by almost 50 basis points. The inversion is the deepest since 2000. Some say this definitely points to a recession. Others saying, look, this time is different because of all of the liquidity that the Fed and other central banks have been put out there. The picture for the UK down at 0.1%. You can see a similar case for the CAC 40. A lot of focus today is also on energy prices. We're now talking about possible blackouts in the UK engineered by the government into the winter months, a kind of sort of a plan B that Germany's also looking at to deal with a shortage. Now, a big day for eco data. Traders counting down to the latest U.S. inflation figures.
Look at inflation expectations.
The inflation expectations.
Consumer inflation expectations are dropping.
Inflation expectations and break-even inflation rates starting to come down from their highs.
Probably 100 basis points is not necessary.
We are at an important inflection point in the inflation story.
If we've reached peak inflation, what does that really tell us?
We're going to see inflation decline, but to what level?
Does it mean it's really going to fall down to that 2% target that the Fed is looking for?
Because the forecast in the Fed to say that they're at neutral.
The labor market right now is very strong. Inflation is very high.
It makes the notion that we're at neutral comical.
That's a 2% inflation rate.
I find that hard to achieve.
We're still experiencing this inflation surge.
Well, for more, we're joined by Bloomberg's Simon White. Simon, you're a macro strategist. For people that are less familiar with you on TV, you're also a mathematician. So, I know you're looking at U.S. inflation, but what's the killer chart that you're looking at?
Well, I think what I'm looking at for this month's release is the contribution that transport is giving to the main number. So a lot of airtime is given to the shelter component because it's got the biggest weight. But actually, in terms of what's contributing the most, transport has been contributing almost half of the year-on-year headline CPI numbers. I want to be watching that to see if you're seeing any considerable fall. So we'll see today how the numbers influence that.
China's July CPI numbers rose some 2.7%. How significant is this reading?
I think that's very interesting. I mean, it's kind of gone under the radar for now. It may turn out to be nothing, but I think you would be kind of you need to keep an eye on it as basically a potential macro risk, because if China gets into a situation of high inflation, they have the potential for a wage price spiral, and then the knock-on effects are potential major yuan devaluation. Now, it's a low risk right now. I don't think people are really thinking it's a risk you need to be paying attention to today, but we've seen a lot of unexpected things happen this year. So if it were to happen, it would have pretty big implications for the macro outlook.
Simon, thanks so much. Simon White there, our resident macro strategist, but also mathematician. So I'm a little bit obsessed actually with your maths degree, so we'll get back to that and see what it can tell us about maybe the 210 inversion. Now, we're joined also by Alex Brazier. He's deputy head of the BlackRock Investment Institute. In a previous life, you were basically a central banker, so it must be extremely interesting on the other side to say, like, wow, are you glad that you're not into the central banking world anymore? Because it seems like they can't get it right.
Well, yes, I am glad, is the short answer. I think it's a difficult time for them for a number of reasons. The first reason is obviously the sharp rises in energy prices, which drive up headline inflation, and we'll see more of that we've seen it in Chinese inflation this morning. We'll see it coming down in US inflation this afternoon, but still very high. The more fundamental issue, though, and this is what makes it so difficult for them, is that economies just don't seem to be able to operate at the same level of activity as pre-pandemic without shortages and generating inflation. And that puts them in this terrible position between a rock and a hard place of slam the brakes, cause the deep recession, or live with these shortages and live with more persistent inflation.
At some point, do the shortage actually stabilize? I know we're looking at that inflation print, and I haven't been this excited. I mean, not since last month, but certainly this is a very exciting US CPI print. But can inflation go away as quickly as it came?
Absolutely not. So,
zero chance.
Headline inflation can come down, and it can come down reasonably quickly. Okay. We've already seen falls in gasoline prices, falls in commodity prices. So going from 9 to 6 could happen reasonably quickly.
But it's
the other
still
bit.
6.
It's the other bit that counts. It's the 6 down to 2 or 3 even that's going to be really difficult, and that reflects kind of core pressures, broad-based pressures. It reflects the fact that the US economy, like other developed markets, is operating at a higher level of activity that can actually sustain comfortably.
So what do you expect in terms of the US CPI print today? And does it change? I mean, depending on the number they get, does it actually change what you think the Fed does?
No. I think it could,
at any level.
I'm giving some very short answers to these
I like
things.
that.
I think, first of all, it could come down. Headline inflation should come down.
Yeah.
That largely reflects gasoline prices. That doesn't change the underlying picture. Doesn't change this fundamental issue that the Fed is facing, which is broad core inflation pressures, telling them that the economy is operating well above what it can sustainably operate at, and that means it's going to continue raising rates a bit more. The market was probably premature in seeing this so-called Fed pivot.
Is there a danger that the market preempts what the Fed does, so it prices it, and then the Fed just has to do more?
Yeah, I think the market's very sensitive to these inflation prints, partly because it overreacted in the other way to sort of suggested pivoting by the Fed. What we see is the Fed raising rates a bit more to close to 4%, 3.75%, 4%. But it changes course in our view, not because of the inflation numbers, but because it sees the US economy actually contracting early next year.
The 210 spread, this is the thing. I mean, I talk about it as much as I used to talk about LIBOR, like early 2000. Like what is the 210 right now?
Yeah, I think that it's telling us two things, actually. Firstly, it's telling us, obviously, the short end's come up, reflecting the fact that the bond market now is expecting the Fed to tighten a bit more. Equity market, interestingly, hasn't really responded to that.
Yeah.
But it's also more interesting what's happening at the long end. So the term premium has been absolutely crushed. Again, it's back at kind of pandemic low levels. That makes us cautious about US Treasuries at the long end, and it's one reason why we expect over time Treasuries not to deliver particularly good returns.
And equities, therefore, at some point need to correct?
Well, I think equities are taking too much hopium at the minute. They've kind of seemed immune to the fact that the Fed is going to continue raising rates in the short term, and certainly immune to the fact that, consistent with that, the US economy has stalled and is going to enter some form of contraction. The restart has stalled. It's going to contract. That's not reflected in earnings numbers. We weren't buying the dip. We're even more cautious now.
All right, Alex, thanks so much. Alex Brazier, their deputy head of the BlackRock Investment Institute, stays with us. We'll talk a lot more about maybe some of the industries that we should watch out for, maybe a bit more inflation resistance, and we'll also talk about the Bank of England. Coming up, U.S. Inflation Day, in case you hadn't noticed. It's a risk-off mood in the markets ahead of the data out later today. We'll also discuss the prospects of a recession as the Treasury curve inversion deepens. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Micron, the leading U.S. maker of memory semiconductors, has become the latest chip maker to declare that demand is actually falling off rapidly. Speaking to Bloomberg, the chief executive warned investors that revenue won't meet projections, sending chip stocks tumbling.
Due to the macroeconomic uncertainties, as well as due to high levels of inventories that customers have built across various end market segments for us, those inventories are being adjusted down, and that is what is resulting in reduced demand for us.
Let's bring in Bloomberg's chief Asia economics correspondent, Enda Curran, for a macro outlook. Enda, first of all, what does this warning actually suggest for global demand?
Well, they're not the only semiconductor making this warning, Francine, and it does suggest now that global demand for products such as home computers, smartphones, and all the other appliances that consumers were buying around the world during the pandemic, during the whole shift to home kind of phase, is now coming off the boil. Now, experts have been predicting that that kind of demand for those merchandise goods would come off the boil, but it seems to be happening. It has two implications. It's important for East Asia, by the way, because this is a part of the world that really benefited from demand for those tech goods, both in terms of the chip makers in Taiwan and around the region, and of course those producers of smartphones and everything else in South Korea and China. The other angle on it, I would say, is that it could impact capital investment. A lot of companies, again, in this part of the world had pledged billions in terms of investment in their semiconductor facilities. Governments around the world had been encouraging that too. So if we are seeing now a turn in the semiconductor cycle, it could suggest a cooling both of exports out of Asia and, of course, the capex cycle for those companies involved.
And how much of this is an industry problem or an industry concern? How much of it is it the world going for a pretty big slowdown?
Well, there's no doubt there could be some industry issues, specific issues involved. Part of it could be, for example, reflecting a build-up in inventories, Francine. A lot of factories that I spoke to last year were saying they were doubling the pace of semiconductors that they could buy because they wanted to buy them when they could get them. And perhaps now what they're doing is basically running down those inventories, which would be more of an inventory story rather than a demand story. But nonetheless, though, you have to look at what's happening globally. Mortgage rates are going up, central banks raising interest rates, inflation hurting consumer sentiment. It does speak to fading demand for merchandise goods, and it looks like we're starting to see that through the technology cycle now.
Enda, thank you so much. Our chief Asia economics correspondent there, Enda Curran. Now we're back on the markets with Alex Brazier. He's deputy head of the BlackRock Investment Institute. And Alex, thank you for sticking around. You were basically saying that, we'll probably do a correction in equity markets. If you look at some of the industries, I don't know how you read China. So we had CPI prints today, maybe more elevated than expected. What do you do with China right now?
Yeah, we are neutral on China, but we see some pretty big forces weighing on growth. And we were just hearing about some of them there. China was a massive beneficiary during the pandemic from this shift towards goods production, goods consumption and away from services, with export growth, annualized 15%. As that reverses, as that trend reverses, as the West starts going out again and buying fewer electronic goods and other goods, that export growth is going to come right off and be a real drag on Chinese GDP. That matters because the authorities, if they want to hit their growth targets, will need to stoke up domestic demand. And that's where the inflation number comes in as a possible constraint on that.
Will they put policy in place to do that? It was unclear. I think in the last 10 days we had doubts about whether the Chinese policymakers would actually do enough.
Yeah, I think that's right. And our view is they will do something, but they will, on balance, be a bit grudging about it. And so this reduction in export demand, from which they've hugely benefited, as it goes away, they will see some of that transfer to GDP growth because domestic demand won't take up all of the slack.
Alex, what do you do with UK assets? So we have the Bank of England with this really dire warning. I mean, half the people are basically saying, look, you're too pessimistic. This is not, you are behind the curve and you should have done more. And then they're really got praising, for example, from Mohamed El-Erian saying, well, this is the only honest central bank.
Yeah, I do think they're showing that honesty is the best monetary policy. And the key thing they're being honest about is that to get inflation down to 2, they actually need a recession in the economy, because even looking through energy prices, food prices, it's a bit like we were saying about the Fed. Inflation is running hot. The economy is running at a level above what it can comfortably sustain. And so the bank faces this really invidious trade-off between a recession or more persistent inflation. Inflation can come down, headline inflation, sure, as energy prices come down. if that happens. But the key issue facing the bank is actually this fundamental stubbornness of broad-based core inflation.
Can the government and the new prime minister, whoever that may be, put policies in place to avoid a recession?
Well, I think that's difficult because the bank would then need to respond in order to get inflation down. So there's, again, another trade-off here. But what the UK is showing, more clearly than the Fed has shown and the ECB has shown, actually, is this stark trade-off that all central banks in developed markets are actually facing, which is if you want 2% inflation in 2 years' time, you have to have very, very weak growth, possibly a deep contraction over the next 18 months.
But Alex, so what does that tell us? That the mandate is wrong, or that actually we're finally realizing that the reach and the power of central banks is very limited?
Well, I think the power of central banks to actually keep inflation on target month after month is obviously very limited.
Right.
The interesting question is how quickly you bring it back after it departs. And what we really need now is a kind of debate about, well, what's the appropriate speed to bring that core inflation down, given this trade-off? And is 2 years the right speed? It's the normal speed, but that involves a deep recession. So we may find ourselves living with a bit more inflation in the US and the euro area and the UK as central banks basically bring it back in slightly more slowly.
Alex, thanks so much. Alex Brazier there, Deputy Head of the BlackRock Investment Institute, joining us this morning. Now, coming up, the richest man is short of cash. Elon Musk offloads almost $7 billion of Tesla stock in case he's forced to buy Twitter. We'll bring you that story next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Elon Musk says he needs the cash. The world's richest man has sold nearly $7 billion of Tesla stock in case he's forced to buy Twitter. The sale, Musk's biggest on record, comes just 4 months after he said he had no further plans to sell more. Well, Bloomberg Quick Takes Alex Webb has the story. Alex, you're a great Elon Musk watcher, and you understand maybe his thinking more than most. So why now?
The shares have recovered quite a lot since their lows. They were, at risk of dipping below $600 at one stage. They're now back up in the 800s. So if this risk is coming up, even if he doesn't have to buy Twitter, there remains a possibility that he'll have to reach some sort of settlement. And that number's been put anywhere as high as $10 billion. So he needs to cover those costs. The odds are the sort of band of investors he had brought along with him are not going to want to stomach those costs, so he might want to cover them himself.
So was that the most interesting part, that actually he thinks investors will pull out? Do we know who?
Well, the names like Larry Ellison, the big ones in there, a lot of other sort of prominent Silicon Valley figures, people who have long backed him. I think the biggest takeaway for me is twofold. It's like what it says about where he thinks Tesla stock is going to go, and what he thinks about the Twitter deal and how that's going to play out for him. He had been going into it saying, oh, there's absolutely no chance I'm going to win this. Well, there clearly is a chance that absolutely no chance I'm going to lose this. There clearly is a chance he's going to lose this. He could also say that right now he's kind of taking some profits. He's going, well, I'm not super confident that the Tesla stock is going to be here come year end. Clearly stuff like CPI print will have an impact on
Alex,
that.
if you're a Tesla investor, this is a nightmare.
It is a real head scratcher, and it also, speaks to one of these risks of investing in fundamentally Elon, right? He is sometimes going to go off and do wildly unpredictable things. You take the rough with the smooth. This is absolutely the rough. It's a distraction, but it also has an implication directly in your investment because they're selling a big chunk.
Alex, there's a Twitter case. Is it like in front of a jury? Is this like Amber Heard versus Johnny Depp kind of case?
So it's not a jury. It's held by it's overseen by a judge, right, in Delaware. I think the court case is going to happen in, I think, October. Elon's lawyers have tried to push that back to the new year. I think they suffered a bit, considered like the weigh-in for a boxing match. He certainly came out the worst in the weigh-in than did Twitter itself. It looks, the case history seems to suggest it's going to be very hard for him to win this. There are very few instances where the person trying to pull out of a deal has succeeded in doing so, largely because the difficulty is showing why you need to pull out. And he's basically saying that they lied to me about this,
the bots
this
and things
data,
like that.
right? And actually, that was never in the original agreement. That ultimately, he said, I buy this, I'm not going to do any due diligence. If they haven't provided the data, then I pull out. That isn't a justifiable reason to do so by a lot of counts.
Okay, so do you wake up and just read his tweets first thing you do? Because that's what I do. And then I sometimes love him and hate him. It's a very complicated
In all
relationship.
honesty, I don't actually follow Elon on on Twitter because I know that anything meaningful, a lot of it is guff. Anything meaningful is going to be retweeted into my stream. I don't need the kind of constant pressure of it feeding into me.
You're a company man. You're expecting, Bloomberg News to write it before you see it from the man himself.
I get those alerts more recently. Can I point out one other story, though, that I think is really significant, not as many people talking about? Twitter is a sort of $25 billion company. There is a huge court case impending to do with Google. And that is something that is a massive deal because it is tackling Google's advertising business. And Google's an advertising company, not a search company.
Yeah, so we have to look, of course, actually we'll get you back on and delve into that a little bit deeper. Thanks so much, Alex Webb there from Bloomberg. Quick take, coming up, Trivago touts strong second quarter results, but prepares for a travel slowdown ahead. We'll be speaking to the chief executive, Axel Hafer. He's up next, and this is Bloomberg. Inflation fears, stocks and bonds drop before key U.S. CPI data today. Chinese price growth hits a two-year high. The big sell, the world's richest man, Elon Musk, offloads nearly $7 billion of Tesla stock in case he's forced to buy Twitter. Plus, collapsing demand. Micron is the latest chip maker, warning that business is rapidly crumbling. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, time for some earnings news, and Trivago has touted strong second quarter earnings results. The German meta-search company says while it continues to experience high pent-up demand, it also expects a slowdown in travel in the second half of the year and beyond. Well, we're now joined by Axel Hafer. He's the Chief Executive Officer of the travel platform Trivago. Axel, as always, thank you so much for joining us. I have never seen such a traveling boom. People want to go on holiday. I speak to, of course, my friends around me, but also a lot of the cab drivers, 3 holidays in the summer. What happens in the later part of the year?
Yeah, we expect that the demand will come down, to be honest, because prices are very high and there is a lot of pent-up demand that we have benefited from and all the other travel companies have benefited from. But on the other hand, there are big labor shortages, and I guess a lot of us have experienced that there is an imbalance of supply and demand, and we think that will come down.
Axel, is this because people worry, are they spending too much money now and then worry as winter comes and they have to pay for bills? Is it inflation? Like, how do you see that correlation between people cutting down on travel as one of the first things as we get into the winter months?
Yeah, I mean, it's a combination of things. I think one thing is that people actually have saved quite a bit of money during the pandemic because they couldn't travel, they couldn't go out, they couldn't spend. So there was quite a bit of money that was now spent on doing trips. The other one is that obviously inflation is hitting us everywhere, and so depending on where you are based, I mean, for example, in Europe. Energy prices are sky high, and in winter people will feel that a lot more. So the disposable income is coming down, and the combination of that will just lead to lower travel activity.
Axel, tell me a little bit about how people's spending habits when they travel changes. Do they go for luxury hotels but want to pay for cheaper flights? Or will they also spend on expensive flights because they just want to get to where they want to get to?
So what we are expecting is that people will save on transportation because that's where it is easier to save money. And we see that, for example, in the UK right now, the share of domestic travel is higher than pre-pandemic already. And we expect the domestic share to go up pretty much everywhere. And that's how you can, with the same budget, still get the time that you need to get a break by just going for cheaper destinations, basically.
Axel, what can you tell us about the most popular destinations? Again, we have this pent-up demand because of COVID. Has it changed the way we travel forever, or is it just in a short period of time?
Yeah, I mean, the top destinations are basically back to where they were. I mean, Dubai, obviously very popular in the UK, but also the big cities where you want to travel to, London, Berlin, in the US, New York, Vegas. Those are the top destinations. And And I don't think that will really change. And we've seen different destinations during the pandemic where it wasn't clear that you could get to certain destinations. But I think the most attractive cities are still the most attractive cities. So I don't think that will change in the next couple of years.
Okay. What's the most attractive city? Has it changed in the last 2 years?
No. I mean, depending on which country you're looking at, in the US it's Vegas and New York. In the UK it's Dubai, London. It's a bit different country by country, but the big cities, the most popular cities, the tourist destinations are still on top of everybody's list.
Long lines at airports, thousands of cancelled flights. How long are you expecting this to last, Axel?
Yeah, I think it is actually a big problem, and you see labor shortages in a lot of sectors in most of the big markets, but the hospitality and travel industry is hit hardest, and the reason is obviously that it wasn't a very stable job through the pandemic, and a lot of companies have also reduced their staffing levels, and it will take quite a while to go up in staffing levels. And to be honest, it's also a matter of increasing salaries to basically get everything back to balance. So I think it's likely that prices for traveling will have to go up to get to an equilibrium really of supply and demand again.
Axel Hiffer, thank you so much for joining us, the chief executive there of Trivago. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Republicans are rallying around former President Donald Trump in wake of federal agents searching his home in Florida. From members of Congress to potential rivals like Florida Governor Ron DeSantis, they echoed the former president's statement that the search was politically motivated. FBI agents searched the Mar-a-Lago residence as part of an investigation into missing classified records. Here in the UK, households are already almost £1.3 billion in debt to their energy supplier before it's even winter. And that is when bills are set to surge yet again. British consumers typically build up credit with their providers during the summer when energy usage eases. That limits the shock of higher demand in the winter. But soaring gas and power prices have made this summer expensive. China's consumer prices rose 2.7% in July. That was below estimates, but still amounted to the fastest inflation rate in 2 years. And was higher than the June figure. A surge in pork prices was a key driver. Meanwhile, the rise in producer prices slowed to 4.2% last month from 6.1% in June. Several of Europe's major rivers are running dry, disrupting $80 billion in trade routes. Blame it on a very dry summer that has set heat records across the continent. The Rhine has dried up to the point of becoming all but impassable at a key bottleneck that is slowing down vast flows of both diesel and coal. In South Korea, the capital Seoul is bracing for more rain after being hit by one of the worst storms in more than a century. Widespread flooding has killed at least 9 people. More than 20 inches of rain has fallen. Opposition lawmakers are criticizing the president for his response to the disaster. And 3 professional golfers who joined the Saudi Arabia Finance Live Golf Series will have to sit out of the FedEx Cup's playoff after a judge refused to lift their suspension by the PGA Tour. Taylor Gooch, Hudson Swafford and Matt Jones qualified for the playoffs and its $18 million top prize, but were banned from participating because they also joined the rival Live circuit. The golfers say the PGA ban is anti-competitive. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, Prudential's first half earnings rose less than expected as the pandemic disrupted sales in key markets like Hong Kong. We'll speak to the insurer's chief executive officer. He's Mark FitzPatrick. That's coming up next, and this is Bloomberg. Well, economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. We're just getting some breaking news out of China. China ending its Taiwan military drills. This, of course, was started last week. It lasted for 5 days, and it was on the back of that Nancy Pelosi trip to Taiwan. They're saying that they're going back to some of the regular patrols that we've seen from China in the last couple of years. Now let's get straight to some earnings news. Prudential's first half earnings rose less than expected as the pandemic disrupted sales in key markets such as Hong Kong, underscoring the challenge posed by the insurer's pivot to Asia. We are delighted now to be joined by Prudential's Chief Executive Officer. He's Mark FitzPatrick. Mark, thank you so much for joining us. First of all, given some of the border closures that actually affected Chinese customers, what does it mean for Prudential's strategy? Does it change where you want to be focused on?
So Francine, hi, good morning to you. It's great to be here. I think in terms of the border closed between mainland China and Hong Kong, what it does, it means that we're pivoting now on our domestic business. So the domestic business in Hong Kong with 7 million consumers, great opportunity for us to meet their health and savings needs. And we've seen a real uptick in terms of consumers in Hong Kong trying to get more health and protection products. We saw a real uptick in COVID cases in the first quarter of this year. There was a hard lockdown for the 5th wave in Hong Kong. And effectively what we've seen coming out of that is a relaxation of some of the COVID restrictions down to 3-day quarantine in Hong Kong, which is great, and a real opportunity now for the business to bounce back.
So what are you expecting, Mark? More Chinese buyers purchasing insurance in Hong Kong? Are they looking for more local providers? What do the next 18 months look like?
So I think what every quarter, Francine, we do an exercise and a survey, independent survey, that actually asks people in Chinese mainland what is their intent of coming down to Hong Kong when the border opens. And what we've seen is a dramatic increase in appetite for mainland Chinese consumers to come down to Hong Kong and to buy insurance policies in Hong Kong. And effectively what they get when they come to Hong Kong, they get different currency options. They get an option to participate in critical illness cover, and they also get an option to be able to participate in the phenomenal healthcare system that we find here in Hong Kong.
Mark, give me a little bit of a sense of, now that the Pru is largely, of course, focused, if not all focused in Asia, will you delist from London?
So I think what we have is we have two primary listings. We have a primary listing in London and we have a primary listing here in Hong Kong. And we raised $2.4 billion in an equity raise last year here in Hong Kong as a way to try and increase people's awareness and increase our profile here and get more investors that are familiar with the Asian market. What we're looking at going forward, I think, is to really make sure that we drive through our pivot to Asia. It's going to be our home going forward. We are agnostic as to the question of domicile, and as to regards the element of listing, about 40% of our shareholders are based in and around the UK, and most of the liquidity today is traded through the London line. We are, though, that being said, we are applying and we are trying to get onto the Hong Kong Shanghai Index. If that comes through, and we'll hear later on this month if that comes through, that should create extra demand, but also give access to the Shenzhen and Hong Kong Connect.
How can you expand in China? Do you want to expand in China?
So the mainland Chinese market is huge, and generally speaking, what we're seeing is, and the regulators ask for, is greater penetration of insurance products. I think on average it's about 2.5–3% at the moment. The regulator's trying to aim for about 5%. So mainland China is a huge market for us. It's one that we'd like to get into even more. We're in 99 cities, access to 6,000 outlets there, and it's a great opportunity for us to grow into that footprint and really do a lot more in mainland China.
Mark, any interest to take a majority stake, for example, in some of the joint ventures with CITIC?
So the CITIC joint venture is a great joint venture. We hold 50-50 with CITIC. We would love to own more. But that being said, while we're a willing buyer, you need to have a willing seller. In the absence of that, all our attention is focused on driving that business forward. And we printed some great numbers today in terms of its profits and in terms of its sales and its overall kind of scale that we're reaching. So we've outperformed the market in mainland China by 4 times in this last 6 months. And since 2017, we've continued to outperform the local market. So we're clearly doing something right. We're clearly connecting with consumers, and we've clearly got the right product set that they need.
Mark, give me a sense of how inflation overall will hurt your earnings. Do you worry that, inflation, we're talking about peak inflation, but inflation's here, it's here to stay. And so at some point, customers will have to face whether they continue with insurance or they actually pay for gasoline.
So I suppose an element to bear in mind is that, so we saw mainland China produce and print its CPI number earlier on today, 2.7%, a far cry from what we're seeing in the UK, Europe, or in the US. Undoubtedly, inflation is going to have an impact in terms of where consumers spend, and therefore, Francine, to adjust to that, we're creating new products, we're creating an ability to be able to reprice, we're creating more bite-sized products so that consumers get some protection, but without necessarily needing to commit for a multi-year policy or a very large policy that might tie their hands up financially. So we're trying to adjust our product set for the economic environment that we expect to see over the course of the next couple of years.
And Mark, when you look at China's Common Prosperity Drive, which really has resulted in the bankers' pay and how much you can pay them, do you struggle or worry about banker retention? Insurance, individual retention? So
our retention levels in our business in mainland China is fine. There's no issue with that component at all. We're actually seeing, because we have the backing of a state-owned enterprise and because of our brand in mainland China, actually we're a source of, we're a magnet for really interesting talent that wants to come into the insurance world. So people come in because they see there's an opportunity to work with the Western organization, but yet one that's got fantastic backing with CITIC, and actually that's winning. And people want to be with the winning organizations, so they're coming to us.
All right, Mark, thank you so much for the interview. Mark FitzPatrick, there, the Chief Executive of Prudential. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Elon Musk has sold $6.9 billion worth of shares in Tesla, the first time he's sold the stock since dropping his bid to buy Twitter. The shares were sold on Friday of last week. Musk has now offloaded around $32 billion of Tesla stock in the past 10 months, but now says he is done selling and will buy Tesla shares again if the Twitter deal doesn't close. Coinbase has posted a $1.1 billion loss and lower than expected revenue as the largest U.S. cryptocurrency exchange was battered by tumbling digital asset prices. Coinbase has slumped 65% this year in what has been labeled a crypto winter. Revenue declined to over $800 million, missing average estimates, while Bitcoin's share of the trade increased to almost a third.
I think it was a rough quarter for most companies. In the crypto space, we obviously had some big episodic events that happened during the quarter. And so some of those asset prices shrunk, which then impacts things like the assets on platform and other numbers.
And Bloomberg has learned that the U.S. Justice Department is preparing to sue Google as soon as next month for alleged illegal dominating of the ad market. It would be the DOJ's second case against Google after its 2020 antitrust lawsuit. In a statement, Google said its ad technologies helped websites, apps, and small businesses reach customers around the world, and that competition has expanded options for both publishers and also advertisers. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, Kenyan authorities are counting ballots in the country's presidential election. We're live from Nairobi next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Kenyan authorities are counting ballots in one of the closest presidential elections since the country reintroduced multi-party democracy 3 decades ago. Our very own Jennifer Zabazaja joins us now from Nairobi. Jen, so counting is underway. What's the state of play currently?
Yeah, Fran, good morning. Counting is underway. We've been anxiously awaiting these results, as the rest of the country has as well. The last update that we had is that just about 15% of the votes were in, about 2 million votes counted. And right now, it's looking like a slight lead for Deputy President William Ruto over Raila Odinga. But I have to stress, and I know you were saying it before, it is still very early. There's still a long way to go. And the one thing that we did hear from the electoral agency is that voter turnout was significantly down this year, about 60%, less than 60%, which is really significant because this is a very young country. They wanted to get out the vote. Both of these candidates really pushed forward on this. But the whole country, the whole world, and really the markets are awaiting this decision to see who is going to be the next president of Kenya.
Yeah, any market reaction so far?
Well, the reaction, I mean, if you just look on the streets of Kenya right now, it's about noon here. And I have to say, it's relatively quiet. I mean, what a lot of people were anticipating going into this was a lot of anxiety. We saw that reflected in the markets. We saw the Kenyan shilling depreciate. We saw foreign outflows accelerating because the market was really concerned about the potential for unease and instability like what we've seen in previous elections here in Kenya. But if you just look out, and I'm sitting outside right now, it's pretty quiet. People are back to business as usual. So this could potentially signal what people were hoping for, which is a peaceful election, which then encourages peace and stability within the Kenyan markets, which could be reflected now by the market. We're seeing the shilling up the most that it's been in 4 months. We're seeing stocks have some gains as well. And so investors are going to be paying attention very closely to who this next president is, because they're going to be dealing with an economic crisis in terms of debt, in terms of how to get out, to encourage more jobs. And so there's still a lot to pay attention to and that the market is watching.
Yeah, and inflation is so rampant, Jen. For the next president, what will have to be his top economic priority on day one?
Yeah, Fran, I mean, I know all throughout the morning with Bloomberg television, we're paying attention to U.S. CPI. That's significant here, too, for the next president, because whatever the U.S. CPI inflation number, that's going to affect what the Fed does, which will in turn put even more pressure on emerging markets like Kenya. Kenya's debt over the past 10 years that we've seen with outgoing President Uhuru Kenyatta, $72 billion right now, $6 million of that owed to China. So if we do see global interest rates rise, which we've been seeing from central banks across the world, that's going to put a lot of pressure on the next president. And so he's going to have to figure out 8.3% inflation here and how to help Kenyans who are already suffering from starvation and drought, how he can help them get more, support the economy better. Fran?
Jen, thank you so much. Jen Frizabazaja there in Nairobi for us. Now, we're just getting SoftBank seeing some 4.6 trillion yen gain on Alibaba transactions and valuations. I know that will be one of our main stocks to watch. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz, and Danny Berger. This is Bloomberg.
We are at an important inflection point in the inflation story.
Inflation in the US looks very different from other areas like the Eurozone.
You know, the economy is not out of the woods.
The economic environment will eventually shift.
We are absolutely seeing a very disrupted economy begin to heal.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The fight against inflation. The latest U.S. Consumer Price Index is out at 8:30 New York time. Elon Musk hedges his bets. The world's richest person sells a record amount of Tesla in case he's forced to go ahead with his deal to buy Twitter. And the great rivers of Europe run dry from the Rhine to the Danube. Crucial trade routes are on the verge of becoming impassable. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Anna Edwards. Matt Miller and Kailey Leinz are in New York. And Kailey, it's all about risk aversion, curve inversion, and this pre-CPI trading session.
Yeah, happy CPI Wednesday, Danny. That really is what it's all going to be about today, 8:30 a.m. Eastern time when we get that inflation data here in the U.S. U.S. It's going to be less about the headline today, much more about the core. Now, of course, the Asian session closed before we got that data, but we did get inflation data out of China overnight, 2.7% on CPI there. That is the fastest acceleration going back 2 years, in large part due to pork prices. So that had a hand in taking equities lower in the region, with the CSI 300 down about 1.1%. The real underperformance, though, came from technology. The Hang Seng Tech Index down nearly 3 full percentage points. Every stock in that index down on the day, and particular underperformance was coming from semiconductors. After the warnings we got from U.S. semi companies like NVIDIA and Micron in the last couple of days, that's weighing heavily on Asian semis as well, including Taiwan Semiconductor down about 2% overnight. Finally, we're going to have to pay close attention to the bond market all around the world today, considering that inflation data could have the power to move it in a material way. Ahead of that, though, you did see yields really up across the Asia Pacific, including in Australia, where that 2-year yield rose about 7 basis points, Matt.
Yeah, I think the chip story is absolutely fascinating. What a time for U.S. chip makers to be getting $52 billion in subsidies from the government. Nonetheless, that'll have little effect on what you see in futures and today's trade. Nothing's really going to move the needle until the CPI number comes out. You'll see maybe some fluctuations. We are up 0.3% on the S&P, but pay attention to, well, the cash close was 41.22. So that's the number you need to keep in mind when we get to the open at 9:30. The U.S. 10-year yield coming down just a little bit as investors buy bonds, but not really much movement, not even a full basis point at 276.81. And NYMEX crude not even moving that much, still holding at that $90 level for a barrel of Texas Intermediate. Even Bitcoin is seeing like zero volatility right now, 23,100. It can't be understated, Danny, how important this CPI reading is, and traders are loath to make moves until the print.
And look, it's not just true in the U.S., it's certainly true in European trading as well. At first, we were getting that downdraft, that negativity from Asia, from the U.S. session because of the bad reports coming from Micron and those losses in semiconductors. But in the past half hour, Matt, we finally saw European indices flip positive. Now, we're just slightly positive. Again, it's this drift that we've seen over the past 2 hours as we get closer and closer to that monster data in terms of importance. So DAX, one of the outperformers, that along with the FTSE MIB up nearly 0.3%. A lot of just flat indices. UK is flat. CAC 40 is also flat. Now, we're also looking at not much happening in the euro either. Still sitting firm versus the dollar at 102.18, but certainly one to watch when we get that CPI data. If it is hot, continue to see that dollar outperformance over the euro, considering we've already had a hike from the ECB. They can't go at it much faster than the U.S. And a reminder for all the folks out there, this is a global bond market. As we look at the U.S. 2s 10s curve invert pretty dramatically, the most since 2000. Yet again today, we've seen the UK 2s 10s curve invert as well. We are -1 basis point. Worth reminding that, yes, the U.S., that is a good indicator of recession. There are a lot more technical issues going on here in the UK that doesn't make it as good of an indicator, but it just indicate this front loading of hikes that is expected throughout the globe. I should say New Zealand. That yield curve also turned negative as well. Finally, wanted to point out UK nat gas futures. Those are up 6%. There's concern that we might see rolling blackouts for industry and households in this country. A great scoop from Bloomberg late yesterday saying that in the worst case scenario, again, this is not the base case, but Kailey, in the worst case scenario, there could be blackouts in the country.
Yeah, and we'll have more on the energy story in Europe and how drying rivers are exacerbating it in just a moment. But first, let's take a look at what is happening today. We'll get some Fed speak, including Chicago Fed President Charlie Evans and Minneapolis Fed President Neil Kashkari. What will they say about today's inflation data? Then on the earnings front, Disney will be reporting third quarter results after the bell. Russia CPI data will be released at 12 p.m. New York time. But of course, before that, the big event of the day, U.S. CPI data, 8:30 a.m. Eastern time. It's been called the most scrutinized economic report in the world, and it will give us a sense of where the fight against soaring inflation in the U.S. stands. Let's get more on that story now. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us for a look at what to expect. It is also his birthday today, so happy birthday, Mike.
Thank you.
Your gift is inflation data.
Oh, boy, how lucky I am. Matt was talking about how the markets around the world are holding their breath What's going to make them exhale? Well, they'd like to see some progress made on inflation, some sort of peak. And as Kailey said, that'll be about the core. We do have some headline numbers that should go down because, of course, gasoline prices have been falling since June 14th, and that takes away a lot from the headline numbers. We're also seeing agricultural commodities come down, so maybe food comes down, but that'll take a little bit. Used cars has been a bugaboo. That's sort of come down. So we're looking for some headline back off. The problem is with the core, and the core is driven a lot by housing. And you can see this line is the one that's not going in the same direction. That is rents, and that is a problem that tells us that core inflation is going to be high for a while. The markets are leaning maybe a little bit higher than they were in terms of the numbers. Right now we're expecting 8.7%. A little bit of a drop for the headline, but it's that core that's going to bother people. While we, on a sequential basis, maybe have a decline, the year-over-year number is expected to rise, and that'll keep the Fed on notice. Now, if we get a much bigger number than any of these, that'll start the talk again about the Fed maybe going 75 or even 100 basis points in September. If we get these numbers, we can talk about 50 and everybody can exhale.
All right, well, we are definitely glued to the screen. Mike McKee, thanks very much for joining us. We'll be revisiting with you all day long. Happy birthday, by the way. Now, Bloomberg has learned that the U.S. Justice Department is preparing to sue Google for allegedly illegally dominating the digital ad market. The suit could be filed as soon as next month. It would be the DOJ's second case against Google after its 2020 antitrust lawsuit. Emily Wilkins, Bloomberg government reporter, joins us now out of Washington, D.C. with the details. So, Emily, what do we know so far about this probe?
So Bloomberg has reported that Justice Department officials have been going back and conducting additional interviews with publishers, with competitors for Google. And this really gives us an indication that that second lawsuit now on ads might be coming. Google had about 28% of all digital ad revenue in the last year. And there are some major concerns about exactly what their dominance is of the market and if they are using fair practices. And this is really part of a much bigger federal investigation that we have seen into not just companies like Google, but also companies like Meta, and whether they are violating antitrust provisions and whether they are really playing fair in the digital market.
We also have some breaking news just coming across the Bloomberg terminal. Emily, Donald Trump is confirming now that he will testify today in a New York, he will testify today in a New York probe. What do we know about the Attorney General looking into the former president and how he has pushed so hard against this?
So this is one of just a number of probes that are currently going on against former President Trump. We know that there's one from the Justice Department. We know that there's one from the January 6th panel. We know that there's also this one from the New York Attorney General. And the fact that we are going to now hearing this breaking news that Trump is going to cooperate as well as testify, I think it kind of shows how much the former administration is taking these investigations seriously, that they are participating, that they are going along with things at this point. Certainly, you've seen Trump resist efforts to be interviewed by other groups and organizations that have reached out to him during this point. It's just been a very interesting week for Trump. I mean, given the FBI raid on his Florida home in Mar-a-Lago, looking for documents there, as well as the news yesterday that a federal appeals court is going to allow a congressional committee to get copies of Trump's tax returns, something they were searching for about 6 years. So very interesting to be following all these investigations right now.
Yeah, an interesting week, certainly, to put it lightly. Emily, thanks so much. Bloomberg Government's Emily Wilkins. To Elon Musk, who sold a record $6.9 billion of stock in Tesla. Bloomberg Quick Takes Alex Webb joins us more for now on the latest move by the world's richest person. Alex, I mean, it doesn't feel like that long ago that Musk said he was done selling shares of Tesla. So is he finally done now?
Well, maybe in his mind he is done for now. Things can always change. For now is a very subjective term. Look, you've seen the share price of Tesla recover about 30% from its trough in the it almost dipped below 600 a few months ago. It's now up in the high 90s. That's clearly then good news. And if he has to cover some costs going forward, even if he doesn't have to buy Twitter as a whole, he may well have to pay a assessment fee of perhaps in the order of $10 billion. So covering some of those costs may not be a bad idea. You might then infer that this is a selling signal if you're a Tesla investor, because perhaps he doesn't think the stock is going to continue to increase much further, particularly as we look towards CPI numbers. Well, actually, the stock's called 3% higher today. Perhaps there's a little bit of overhang. There was concern that he was going to have to sell down an even greater amount of the stock. There is a certain amount of clarity on that, as you say, for now. And so we've seen a positive reaction in the pre-market trading.
All right, Bloomberg quick takes, Alex Webb on Elon Musk, Tesla, and Twitter. Now let's get to the Rhine River. It is set to become virtually impassable at a key waypoint in Germany. Shallow waters will effectively halt shipments of energy products and other industrial commodities. It's one of Europe's most important waterways, and it's about to be almost just a foot deep. Chris Ryder, senior editor for Bloomberg, joins us out of Berlin. So, Chris, how big of a disaster is this going to be for energy transports?
Well, it comes at a terrible time, obviously, for the European economy and for Germany. You have the Rhine River more important than ever right now because it's a key conduit for coal that is needed to offset missing Russian gas supplies. So it's a terrible time for the Rhine to be stuck. That's where we are right now. But it's obviously not the only river. Like these issues are affecting waterways across the continent.
All right, Chris, thank you very much. Bloomberg's Chris Ryder there reporting from Berlin. And we're going to get more on Europe's dying rivers later this hour when we focus in on today's Big Take, of course. You can always get that by heading to NI Big Take Go. To Kenya, where authorities have begun counting ballots in one of the closest presidential elections since the country reintroduced multi-party democracy 3 decades ago. Bloomberg's Jennifer Zabazaja joins us from Nairobi. So, Jennifer, we have counting underway. What do we know at the moment?
Yeah, Danny, counting is underway. We're still really early on right now. Only about a little over 15% of the vote. 2 million votes have been counted. Right now, Deputy President William Ruto is slightly taking a lead over Raila Odinga. But as you mentioned, it's still really early on. But what's interesting is sort of how this election is affecting the markets. What we saw going into the election is that the market was very jittery, very nervous. We saw the shilling depreciate more than it has in about a year. Right now, what we're seeing is the Kenyan shilling go up to the highest that it's been in about 4 months. Stocks are up the most that they've been in a month. We've seen bond yields come down. And so it signals to us that maybe investors are a little bit less concerned about the ease that there was around what was to happen after this election. But right now, if you just look on the streets of Nairobi, it's very quiet. People have gone back to work after being off for Election Day. But the next leader is really going to be focused, as you guys are all day today on Bloomberg TV, focused on inflation. Inflation here in Kenya, 8.3%, affects people much differently here. And so the next leader is going to have to figure out how to deal with a hunger crisis in addition to dealing with Kenya's mounting pile of debt, which right now is about $72 billion. And depending on what we see from U.S. CPI and then what the Fed does, that could then put even more pressure on Kenya. Danny.
All right, inflation, a global story indeed. Bloomberg's Jennifer Zabazaja reporting from Nairobi. Thank you so much. In earnings news, it was a massive miss for Coinbase. The largest U.S. crypto exchange reported lower than expected revenue and also posted a record $1.1 billion second quarter loss. The chief operating officer, Emily Choi, spoke exclusively with Bloomberg after the results.
I think it was a rough quarter for most companies. In the crypto space, we obviously had some big episodic events that happened during the quarter. And so some of those asset prices shrunk, which then impacts things like the assets on platform and other numbers.
So clearly the crypto winter is impacting Coinbase in a negative way, and those results are having a negative impact on the shares in pre-market trading this morning. That stock is down more than 7% before the bell. It is an even bigger decline, though, for Roblox, the video game company. It also reported after the bell. Bookings missing expectations really goes to show you that the pandemic boom in video game playing is starting to fade. That stock is down about 13% before the bell. One more positive story out there, though, is an advertising technology company, Trade Desk. We had talked so much about the headwinds in the advertising environment given the deteriorating macro picture, and yet the company is working through that. One analyst calling its results uniquely strong as it beat expectations both in the quarter reported and on the guidance. And as a result, that stock is up 16.5% before the bell, Danny.
All right, Kailey, good stuff there. Just want to bring us a breaking hot headline crossing the terminal mold. It's a Hungarian refiner saying that they will pay Russia's transit fee to Ukraine to restart crude flow. Of course, that had been halted given the tension between European countries and Russia. But again, they're going to pay a fee in order to get that flow of gas continuing. We'll continue to take a look at European gas prices, still up 4% this morning. Well, energy, that folding in to the inflation story. It's, of course, on the minds of us in the U.S. Ed Clissold, we'll speak to him about it, Chief U.S. Strategist at Ned Davis Research. That's coming up later. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Danny Berger out of London. Now, a lot of attention, obviously all the attention this morning is on inflation. We're going to be looking at that CPI data. And as Kailey pointed out, there's going to be this time more focus on the core than there is on the headline number. Within that is transportation, and that's been overshadowed a bit by shelter lately, especially if you look at Fed minutes or mentions by Jay Powell. But transportation has been a much bigger uplift on the number, and it's due to get cut big time this month. Simon White of Bloomberg Markets Live joins us now. So, Simon, explain the transportation expectations vis-a-vis shelter.
Yeah, sure. I mean, shelter gets a lot of the kind of like the coverage because it's got the biggest weight in CPI. But if you actually look at what's driving CPI right now, not just like most of the headline number, but a lot of the volatility is coming from the transport component. So I'll be looking to that today to see if it leads to some sort of decline. I mean, we're expecting a slight decline, and I think transport is going to be the place where you might be able to see that.
It does just feel like such a binary outcome of if it's cold, if it's hot in the market reaction. When it comes to where has the fattest tail and what's the most mispriced in this market, where would we see the most volatility around, the most need to change positioning in this market, depending on what the number is?
Well, I think yields, obviously. I think the market is now kind of looking for this kind of move lower in CPI. We'll get probably a much bigger dip in yields. But I think that's the shorter term picture. I mean, I think inflation is really a play in three acts. First act is we get the rise in inflation. The second act, we get the lull, perhaps a premature easing in the Fed. Everyone thinks inflation's okay again, but then that lays the groundwork for a much larger rise in CPI that requires much bigger hikes, and I think than anyone is really anticipating to get the inflation toothpaste back in the tube.
Yeah, would certainly throw into question that pricing that we're going to be cutting in 2023. Simon, great stuff as always. Simon White of Bloomberg Markets Live. And for more analysis from Simon, from the rest of the Markets Live team, check out MLIV Go on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is off today. Now, keeping you up to date with news from around the world, here's the first word. Republicans are rallying around former President Trump in the wake of federal agents searching his home in Florida. Former members of Congress to potential presidential rivals in 2024, like Florida Governor Ron DeSantis, echoed the assertion that the search was politically motivated. FBI agents searched the Mar-a-Lago residence as part of an investigation into missing classified records. It's another blow to Europe's energy security. Russian oil flows through Ukraine to Hungary, Slovakia, and the Czech Republic were halted because sanctions prevented payment of a transit fee. A Hungarian refiner says it's paying the transit fee to Ukraine itself to get the oil flowing. In the UK, households are already almost $1.6 billion in debt to their energy suppliers before winter, and that's when bills are set to surge again. British consumers typically build up credit with their providers during the summer when energy usage eases. That limits the shock of higher demand in the winter. But soaring gas prices and power prices have made this summer expensive. And in China, inflation accelerated in July to the highest level in 2 years. The consumer price index rose 2.7% last month from a year earlier. The big reason? Pork prices soared more than 20%. Still, weak consumer demand kept overall price pressures in check. And of course, while we've gotten inflation data out of China, Matt, we're still awaiting the inflation data here in the U.S. That's what it's all about today, that print at 8:30 a.m. Eastern.
Yeah, absolutely. We are going to be paying attention to everything from pork bellies to transport. The CPI number could be a huge driver for the Fed's rate hike path.
Yep, and we'll talk more about that coming up next. Ed Clissold, Chief U.S. Strategist at Ned Davis Research, will be joining us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The fight against inflation, the latest U.S. Consumer Price Index is out today, 8:30 a.m. New York time. Elon Musk hedges his bets. The world's richest person sells a record amount of Tesla in case he's forced to go ahead with his deal to buy Twitter. And the great rivers of Europe run dry. From the Rhine to the Danube, crucial trade routes are on the verge of becoming impassable. I'm Danny Berger in London with Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. Matt, I don't know if we can read too much into the moves we're seeing this morning in this market, given, everything could change depending on what happens with that CPI number out.
Yeah, no, absolutely. And there aren't really very big moves in markets so far.
True.
We have futures that are up about 0.25% right now, and the 10-year is coming down almost 2 basis points to 276.08 as investors buy that debt. But of course, this CPI print is crucial. I'm focused on the headline number because I have a bet with Kriti Gupta that last month was the peak, and we're looking for 8.7% compared to 9.1% last month. But the Fed, and I think a lot of other people, including markets, are going to be more focused on the core because we know that gas prices have come down. We know that food prices have come down a little bit. They're still high, but they've come off a little. NYMEX crude, as an example, is trading around $90 a barrel and has been for days now. $89.89 is the price exactly for a barrel of West Texas Intermediate. And Bitcoin really not moving at all. It's typically a very correlated asset. You can even look at it for a tell as to where we're going to be at the open, but not today. $23,097 and not gone far in the last 12 hours. Kailey, what do you see in terms of the pre-market movers?
Well, I have to begin with Tesla because, as Danny mentioned, we had news overnight that Elon Musk had its biggest share sale ever, selling off nearly $7 billion of his Tesla stock just to avoid a fire sale in the chance that he does indeed have to go ahead with his $44 billion deal to buy Twitter. After that, Tesla shares are actually on the rise, up about 2.5%, and Twitter is as well. That stock is higher by nearly 4% in early hours. It's a less positive story, though, for Coinbase. Reported earnings after the bell last night, or really, I should say, a record loss of $1.1 billion, plus revenue and trading volumes missed estimates. So did user growth forecast. So as a result, that stock is down 7.2%. The crypto winter weighing heavily on that company. And of course, crypto, one of the more speculative areas of the market out there. Another one is those meme stocks that have seen quite a resurgence in recent weeks. Bed Bath & Beyond was up 9 days, 156% until yesterday when it actually fell about 14%, snapping that winning streak. Just a little bit of buying coming back in this morning, though, Danny, up about 0.2% before the bell.
Well, but on a day where CPI could potentially make the Fed be more aggressive and perhaps punish some of those bubbly stocks, you get it moving back up. Well, Kailey, we are just narrowly avoiding the dreaded unsht when it comes to this European benchmark index. Europe Stock 600, it is up just 0.06%. It opened up to the downside, so it has turned around, but volumes are light. We're awaiting that U.S. data. Same goes for the euro. Not a lot of action here, trading at 102.30, up about 0.2% versus the dollar. But can that last if we get a strong strong CPI number, will King dollar rear its head once again? And because the U.S. 2s 10s yield curve, that is inverted, we're starting to see the global bond market catch up to it. New Zealand, not that long ago, also flipped to an inverted yield curve. And now we've seen the UK 2s 10s curve. That has just inverted again. It did that earlier this month after the BOE decision, went back positive. Now it's back negative again. So a lot of back and forth. Doesn't necessarily mean recession, but it does indicate that front loading of rate hikes. Finally, nat gas here in the UK, prices of those up nearly 7%. As we head into the winter, this is going to be a critical price to watch. A great Bloomberg scoop out yesterday that come the winter, the UK is preparing for a worst case scenario. When this gets really expensive, the price of energy, and at the same time, a really cold winter, that could potentially mean, Matt, that there are rolling blackouts for both industry and households in the UK.
All right, so very close watch still on the energy crisis in Europe. Let's bring the focus, though, back to the U.S. ahead of this CPI print. Ed Clissold joins us, Chief U.S. Strategist at Ned Davis Research. Ed, you know, this CPI number seems very important. What are you focused on and what do you expect?
Well, yeah, so consensus is calling for a drop in the overall rate. But we're really focused on the core because we all know that food and energy prices have come down over the last month. But in particular, we're focused on core services, which were up about 5.5% year over year as of last month. And that's going to really get at what the consumer is dealing with. The services part of inflation is stickier because if somebody perhaps raises the price of a haircut because it costs them more to drive to work, they're not going to lower that if oil prices come back down. They're going to keep it there. And so that's what the Fed is so concerned about. And therefore, that's what we're looking at as well.
What do you expect the Fed to do? I mean, it seems to me that every Fed speaker in the last few weeks has been telling Mr. Market, no, we're serious. We're really going to continue hiking rates. We're not going to turn around and go back down at the beginning of 23, but the market doesn't believe them.
Yeah, I think the Fed has to keep that message until they really are ready to make the change, because this is the expectations game. Powell has said, he would love to do a 94 type of tightening cycle. That's the gold standard, where they tightened and then turned around before we went into recession. But given the option, he'd rather be Volcker in the early 80s and cause a recession than the late 70s when the Fed was behind the curve the whole way. So they have to talk tough.
Better Volcker than Burns.
Absolutely. So that's what they're going to try to do here. And so I don't think the message is going to change, but I think they're signaling they're serious about 75 basis points at the next meeting for sure.
Okay, so clearly the equity market has been betting on that Fed pivot narrative. When you look at the bond market and a yield curve that's inverted by nearly 50 basis points, Ed, how reliable a signal is that?
Well, so what we're focused on is that we want to see lots of the different parts of the yield curve inverting. And the 10-2s is very critical, of course, but we actually look at dozens of different yield curves, corporates, treasuries, different parts, the 2s 5s, the 10-3 months, and we're at about 50%, but it needs to get a little bit higher to signal a recession. If you look at the last 3 or 4 recessions, if it gets above about 55% or so, that's the Rubicon line for saying the economy is likely to head into recession. I'd also point out that doesn't mean you're going to a recession immediately. There's usually a lead of a couple quarters before the recession takes place. So the yield curves all along the curve, corporate and treasuries, are telling us you really need to be on alert, but we're not there yet.
Okay, so we're not quite there. If and when we get there, Ed, what do you want to be buying in that kind of environment?
Yeah, so I think there's 3 different scenarios we've come up with. We'll use the Goldilocks and the 3 bears. We'll call it Jay Powell and the 3 bears for us. So the first one is too hot. That's when the Fed is forced to keep raising rates for a while because inflation stays too high. If that happens, we'll go into recession. Probably over the short term, we'll see new lows in the factor averages in the next couple of months. Too cold, which we think is the most likely scenario. That's if the Fed is able to pivot in the next couple of meetings because inflation comes down, but they've already done too much and the economy falls into recession next year, in which case you'll probably see new lows late this year or early next year before, and then in the meantime, we'll get a really nice rally. And the third is just right. The Fed manages to pull this off, AKA 1994, in which case the lows are probably in. But history says it's very hard for the Fed to pull off a tightening cycle without a recession. And this is harder than most. So call it a major rally now and then potentially new lows into next year.
Can I hang on to that second scenario of your three bears, Ed, this idea that the Fed will have to pivot? I wonder how likely that is, even if we go into a recession, because I think of Zoltan Pozsar, for example, who points out that the global commodities market, it is just so tight, and that is unlikely to change anytime soon, which again means stubborn inflation. So even if we are in a recession, can the Fed afford to pivot, to start to cut rates when it needs slowed down demand in order to bring it in line with where supply currently is?
Yeah, so now we have to talk about the dual mandate, right? You're absolutely right. The Fed needs to focus on inflation, but the Fed also has a mandate of full employment. And so jobless claims have started to tick up, still very low. But if the labor market loosens quite a bit, that would give the Fed some room. And keep in mind that the biggest input for most companies, the vast majority of companies, are wages. And so if the labor market loosens, then that would give the Fed the ability to pivot. And also a pivot could mean just 25 basis points a meeting, maybe taking a meeting off here or there. It doesn't mean that the tightening cycle is completely over. It just means that they're not nearly as hawkish as they are right now.
Well, when it comes to unemployment, how much signal are you taking? It's mostly tech companies, I realize, but every now and then we get a company reporting in this earnings season saying that they're freezing hiring or they're slowing it down. How much value do you assign to those headlines?
I think it's of note, but you're absolutely right, Danny. It's early days. The overall labor market is still very tight, and this is when we have to handicap for what's gone on over the last couple of years. Those tech companies were able to keep going and even expand during the height of the pandemic. Whereas the parts of the economy that are adding jobs like crazy right now are the parts that were hit the hardest. So it's a very different labor market than we've had over the last couple of years, and so we'll have to look at both segments, not just one in isolation. Which I know that's not what you're saying, but we have to bifurcate the market here.
Ed, a reasonable and a whole picture view, as always. Great chatting with you. Ed Clissold, Chief U.S. Strategist at Ned Davis Research. Coming up, the Rhine River has dried up and will effectively be impassable at a key bottleneck come Friday. Up next, we're going to dig into just that. It's the topic of today's big take on Europe's drying rivers. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today on Bloomberg Technology, an exclusive interview with the CEO of Roblox. That's at 5:40 p.m. Eastern Time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is off today. Well, from the Rhine to the Danube, Europe's water waves are failing at the worst possible moment as both the climate crisis and the continent's energy crisis worsen. That is the topic of today's big take. Jack Whittles, who co-wrote the story, joins us now for more. So, Jack, let's begin with the Rhine River, which has dried up and will be effectively impassable at a key bottleneck come Friday. Where is the water now, and how low is it forecast to go?
Hey, so the Rhine level at Calb at the moment, it is 47 centimetres last time I checked. And it is forecast to go to the critical level of 40 centimetres on Friday.
What are centimetres?
And then
Ignore Matt. Go ahead, Jack.
40 centimetres, just under 16 inches.
Got it.
There we go.
There you go. And then it's going to go as low as 37 centimetres on Saturday.
I love this. Not only have you brought the data with you, Jack, you've also got the translation for our American viewers. Okay, so that's the levels we're at, which, I mean, sound quite low, but put it in context for us. In terms of barges trying to get through these rivers, is it possible at those levels? Is it impossible? Where do we stand?
Right, so important to understand that when I say 40 centimetres, just under 16 inches, that's not literally how deep the river is. The river is significantly deeper than that. That's how they measure it. But when we hit that 40 centimetre level, it basically becomes impossible for a lot of barges that are carrying these vital commodities to get through Kailb, which is just to the west of Frankfurt. And there are still some specialist ones that can get through. The reason it becomes difficult is basically the more you load onto a barge, the lower it sits in the water. And so as the water gets shallower, you can carry less and less stuff. And we're now at the point where basically they'll run aground.
So that's exactly what I wanted to get to, Jack. That means that, you know, a smaller barge or a barge with fewer goods on it, or like the Kelly family, can pass through no problem. But when you start loading up a big barge with coal or with diesel fuel, those are the ones that cannot get through, right?
Yeah, so all the sort of commodity hauling barges, so coal, diesel, you know, big, heavy stuff, when it hits 40, it's pretty much uneconomical for those to get through. There are some special ones that are specially designed that will still be able to get through at lower water levels than 40.
Will they then ship the stuff on roads instead? Or are they going to, put these onto big 18-wheelers and just use the Autobahn?
Right, you can use road and rail as an alternative to the Rhine, but that is a lot more expensive. So it will depend on the economics of whether they'll actually do that.
And expensive at a point where energy is already pretty dang expensive for the continent. How does that feed into the crisis that Europe is already seeing?
Right. So, I mean, Europe is already in an energy crisis. And just to give you just a bit of context, so the Rhine, you know, it's about roughly 800 miles up from the Swiss Alps, all the way down to the North Sea. And there's so much stuff shipped along that river. You know, it's not just coal and diesel. It's iron ore, it's fertilizer, it's cement, it's gravel. It's all this stuff. And Europe is already facing an energy crisis and choking off those deliveries, because it's not just Kailb, where the Kailb is where it's at its worst, but it's all along the river. The amount that these barges can carry is limited. So the whole of Europe is essentially having its supply of these commodities choked off. You've had Switzerland has already had to release, or said it's releasing strategic oil reserves. So have Austria said the same, Hungary said the same. You know, Europe is supposed to have the lowest diesel stockpiles on record, or at least back to 2011, this November, as we go into winter.
And it's so much more important, diesel fuel in Europe, than it is here. Although even here, obviously, for trucks, you have to have diesel. Jack, what kind of picture do you expect to see in and around Kailb, that town west of Frankfurt on the Rhine River, Friday or into the weekend? Are we going to see big traffic jams, the likes of which we saw in the Suez Canal?
Barge owners, they are going to know. They're going to look at this forecast. They're going to have a good idea. So they're not going to be taken by surprise by this. What you might get is some barges that went through Kailb, and because the water is then deeper on the other side, so they might start trading between like Switzerland and Kailb, that sort of more inland area. So you might sort of get two mini canals, if you see what I mean.
All right, Jack. Going to have to end it there. Thank you so much. Great reporting, great big take out today. And if you want to read more of that from Jack Whittles and team, that's on NI Big Take. Go on your terminal, or you can get it on Bloomberg.com. More coming up. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Danny Berger in London. Now, Tom Keene, co-anchor of Bloomberg Surveillance, joins us typically with the single best chart of the day. Tom, I have no idea what you could be looking at today. What are you focused on?
Well, I'm not looking at the level of the Rhine River. I'm looking at the level of inflation in America. And this is a rich story. We can really go forever on this, Matt. This is a huge report that we're going to see this morning. And the report is divided by headline and by core inflation, taking out gas and real estate, but it's also divided by the parts of the American economy. And the two great parts are goods, seen here in red, goods inflation, and service inflation. So let's look at this, Matt. level service inflation with a move up during the pandemic, and we really haven't turned around service inflation yet. But to me, the interesting story to deal with Michael McKee on this morning at 8:30 is goods inflation, which is ballooned from deflation and disinflation up to a ginormous Matt Miller number and is rolled over substantially. Will that continue to roll over into 2023?
You know, you've been talking about this for a while, Tom, and the last time we had this discussion was 2 months ago when the 9.1% headline print came out. That led into a drumbeat over the weekend. We were looking for 50, then people started saying 75. On Monday, people started saying 100. And do you expect a similar kind of step up?
Well, the answer is we don't know until we see the data. What I would suggest is the parlor game is of little value except for those that are playing the parlor game. What matters to listeners and viewers is the idea of what's it mean for my pocketbook. And both numbers matter. Top line inflation looking at 8.7% and the core statistic at 6. Both of those matter. Totally unacceptable. The single best chart I've seen in the research in the last week or 2 weeks is Bank of America, which has model glide paths, 4 different glide paths where we don't calm down until May of 2023. Matt, you're going to be turning in your truck for a new truck by May of 2023.
I'm going to be looking for an EV truck.
Yes.
Can't wait for Matt to drive that over to London and give us all a ride. And Tom, look, you've got a great lineup of guests to ask about this, but I got to say, it's not just the macro, it's the micro of Disney earnings as well. I know you got Michael Nathanson on the program as well.
We're going to do Disney on the back end, and of course, all that's going on in media as well, and particularly with the college rights.
Big Ten football.
The Big Ten football. Matt lived this as a kid, but Big Ten football is real in America, and Nathanson will brief me on that. But before that, Rabila Faruqa will join us here, and Marilyn Watson from BlackRock. And I can't say this enough. The world of global Wall Street will stop at 8:30 this morning.
Absolutely, Tom. We'll all be focused on your program. Tom Keene there coming to us from Bloomberg Surveillance begins in just 5 minutes' time. Danny, you know, I will also be focused on the Nathanson interview because I care whether or not I have to watch or get to watch Big Ten football on I think it's between CBS and ABC rather than ESPN. It makes a huge difference, and it's so much more important, or it's important to so many more people this coming season because we're going to have 14 teams in the Big Ten. So, you know, college football is huge business, and it's going to be a big dollar deal when it gets done.
Yeah, huge business, big money maker. And well, speaking of lots of money in sports, Matt, I mean, we didn't even talk about PGA and LIV today, that the PGA winning that court case that they can prevent some people from playing. I mean, look, I know that this is perhaps a general interest story, but this is a lot of money behind the new tournament, perhaps more money from the PGA or less money comparatively that these golfers are going to be missing out on.
Right. Well, I think it's a general interest story that a large portion of Wall Street cares about. A lot of golf fans. Obviously, a lot of tennis fans as well. We can finish up the sports chat with Serena.
I love it.
She has had such an illustrious career, one of the greatest athletes of all time, and we hope to see her go out on top as a champion at the U.S. Open.
Matt, I am so impressed that somehow in the last 5 minutes of this show, when we were talking about CPI, we've been able to just tie in a sports chat. I think that is true talent. And, you know, besides CPI, the most interesting thing as well. All right, well, that's it for us at Early Edition. More surveillance is up ahead. Again, all eyes move to the U.S. 8:30 a.m. That's when the CPI print hits. This is Bloomberg.